Hi everybody, welcome. Let's go ahead and get started. I don't want to punish you guys for being on time, so I'm sure we'll have one or two people trickle in with the course of the presentation. So again, thank you for being on time and being punctual. I know parking was something of an issue, so I know you may have had to park on a side street or whatever, but I do appreciate you guys being flexible. So welcome to the RMD seminar. For those of you who don't know, this is the required minimum distribution seminar regarding your 401ks and your IRAs and your 403bs. If you wanted to go to the beekeeping seminar, that's down the hallway. Just kidding. Oh, tough crowd. Okay. So again, my name is Alec Tuckman. I'm from a company called Providence Financial. And I'd like to, before we begin, I wanted to let you know that we have a radio show on Saturdays at 4 p.m. I strongly recommend you check it out. We talk about issues just like RMD and any kind of 401k or IRA related issues. Very contemporary topics, always about the economy, what's going on with your personal finances. Very beneficial, so tune in at 4 o'clock. 8:70. That's correct, it's 8:70 a.m., 4 p.m. on Saturdays. So if everyone can just mute your phones or turn them off and just refrain from eating if you don't mind. Drinking is okay, that's not too distracting, but if you can refrain from eating, that'd be great. And this would not be America if we didn't have some kind of disclaimer first. Understand that everything we talk about today is going to be based on general concepts, basic information. This may or may not pertain to your particular situation. That being said, if you did need to talk to me, I'm going to make the next 2 to 3 weeks available for this group in particular. After that, I'll go back to managing my client portfolios. With that 2 to 3 week period, you are able to look in the packet, and we'll get to this in a second. You'll be looking in the packet. There's my schedule. I blocked out, again, certain areas where I'm able to meet with people. If you wanted to schedule a one-on-one, I'd love to do that. Normally that consultation is $200 to meet with me. We're waiving that through the relationship we have through this library. So again, absolutely free to consult with me over the next 2 to 3 weeks. If you're a regular Joe, we do charge. That being said, I really recommend strongly that you take advantage of the situation. We do not have to talk about RMD topics. If you feel confident about this information, we can talk about things like retirement planning, wealth accumulation. We can talk about your 401k if you like, your beneficiaries, but definitely take advantage of the opportunity. It's a window of opportunity. Definitely take advantage of it. Any questions up to this point? Okay, great. So does anyone know what the RMD penalty is for not taking your required minimum distributions? Take a wild guess, please.
10%?
50%.
I said 10. Oh, you said 50.
50%. And all you have to do to be a member of the 50% club is nothing. Simply don't know. Now, there are a whole host of RMD challenges that people aren't even aware of. And generally speaking, people usually retire one time. And when you go through something once, you may be dealing with things like surprises, challenges that you aren't aware of, information. And you'll see information, what's the old adage? Knowledge is
Power.
Exactly. And by knowing certain key issues, that can help you significantly. And that's why we're here today. That being said, there are a whole onslaught of issues you're going to have with RMDs, as owners of RMDs. And you'll learn very, very quickly through this presentation, the devil's in the details. Major details can have incredible effects on your RMDs. For example, if you were to pass, there are different rules if you're over 70.5 versus under 70.5. So along the way, we'll again be addressing several of these issues. But if there are certain things that may or may not apply to you that you think are important, don't be afraid to come talk to me. I'm more than willing to help you. And again, take advantage of the 2 to 3 week period that we've offered you. So let's start with a case study. Meet Samantha, not her real name or her photo. Samantha was tired of watching her IRA go up and down in the stock market. She got frustrated with the sleepless nights. So one day she decided to completely cash out. She took the money from her IRA, walked across the street to the bank, and just wanted to put it in something safe, right? Now, not having gone through this process before, I didn't know if you guys were aware, but there is a 60-day period when you're able to roll over your IRA. That being said, she thought everything was fine. She worked with the representative at the bank, and she made the deposit. That was probably middle of the year. Then fast forward to January, February, she got a 1099, wherein, on top of her usual taxation, she was taxed $45,000, more than she expected. Now, poor Samantha isn't rich. She doesn't have a small business, and she doesn't have a financial advisor. That being said, she after she was able to pick her jaw off up the floor, she collected herself and her wit about her, and she went to the bank to find out what happened. Now you tell me, do you think the person that opened that bank account for her was still at the bank? Of course not. So they said, don't panic, let's take a look. They pulled up information on the computer, and what did they find? They found out that she improperly made a distribution by not rolling over the IRA to another IRA account. For those of you who aren't aware, again, you have 60 days to do a proper transition, right? You have 60 days to do a rollover, whether it's a 401k to an IRA or an IRA to another IRA. So, and that's called something different. That being said, it wasn't done properly. Now, do you know what wasn't done properly? On the most basic level, what was not done? Anyone want to take a guess?
She didn't tell the person.
On an even more, well, actually, she did tell the person. But as the IRS looks at it, it's never going to be the other person's fault. The IRS sees they see things very clearly. No matter what happens, it's always on you. So guess what wasn't happened? Guess what wasn't done? One simple thing. Do you want to take a wild guess?
The check should have been made out to the bank for her benefit.
You're correct on some level, but in this particular case, it's even more basic.
Is it the responsibility that the bank was asking where does this money come from and what your options are?
No, even more basic than that.
She exceeded
This
the time limit, maybe?
This was not done. Someone did not check a box. A simple box was not checked that indicated it was an IRA transfer. That essentially cost her $45,000 in taxes. Now, again, as you'll see, there are a whole host of mistakes. Something this simple could have been easily avoided had she known. Had the person who set this up account for her, had they known as well. So, in dealing with these kind of challenges, that's why you need to talk to someone who's been through this hundreds of times before. Whether me or somebody else, it's important that you're aware of these challenges, right? These obstacles creep up the most silly, basic things. Like I said, the devil is in the details. And by not checking this box, it costs her $45,000. So before we get deeper into the details on RMDs, I want to talk a little bit about myself and my firm. We've been around since 1999. We focus on not just common stock and mutual funds, but alternative investments. If you guys go to a Porsche store, what do they generally sell you? A Porsche dealership, what do they usually sell you?
Porsche.
A Porsche, exactly, sir. So we've gotten away from that. When you go to most big firms, the JP Morgans of the world, the Bank of Americas, if you talk with a financial advisor, they're generally going to try to sell you common stock or mutual funds, right? Well, let's go back to that box. Mutual funds have the disease of ease. Do you know how easy it is to pick a mutual fund? You just do this, and you check another box. There is a whole host, a whole universe of other options out there, and we want to give you the opportunity to explore those other options. Things that are going to generate income throughout your retirement that you're not going to have to worry about cannibalizing your portfolio. And we'll get this a little later. But again, the difference between our firm and other people's is the fact that we take the initiative to give you all the choices, not just common stock and mutual funds. We are a fiduciary, meaning by law, Department of Labor dictates that we act in your best interest before our own. We have great ratings on all the websites, and we're located in Woodland Hills. Now that being said, even though our main corporate office is located there, we meet with offices basically around Southern California. So if you did want to meet with me, we actually have an office right over here on 155 Lake. If you can etch that address in your brain, it's 155 Lake, Suite 800. And that's where we would be meeting if you did choose to meet with me. It's literally about 5 minutes away from here. So you don't have to worry about headaches, you don't have to worry about traffic. We can accommodate your needs.
What is it, 155 Lake?
Correct, 155 Lake, Suite 800 in Pasadena. And as you can see, our firm has been featured on CNBC, USA Today, Pasadena News, Journal, you name it, we've been there. We've also been voted #1 advisor in the state of California in the year 2013, so hopefully that means something. So let's talk about a little housekeeping items before we get back into the presentation. You'll see some documentation I've given you in your packet. #1, you'll find information on me in case you're curious. You'll find all about me in my one-page bio. #2, we have a company brochure. If you're curious more about our personal philosophy, if you talk to 100 different firms out there, you get 100 different viewpoints and philosophies and strategies. What you'll see in the brochure is ours. #3, you'll see something called the CCI, or the Client Information Form. All that is basically giving us the opportunity to learn a little bit about you and save us about 20 to 30 minutes if you did decide to meet with us. Now, what this does is give us an opportunity to give you a snapshot at a very high level about where you are in life and what your goals are. You would not go to a doctor and go into surgery without first getting an x-ray. This is our x-ray to get a better gauge of who you are and what your goals are. Next, we have the presentation outline. That's been provided to you in case I talk too slow, too fast. I want you guys to be able to keep up. Yes, you'll see some slides that aren't in the outline, but by and by, that's the pacing you'll see us go through. So if you have questions, make sure you feel free to write those questions down on the outline. I hope I'm not the only person that's guilty of forgetting these great questions when I go and talk to a professional. This is going to give you the opportunity to avoid that scenario and make sure you're well informed and there are no surprises and you aren't scratching your head at 3 in the morning saying, what did I want to ask that guy? Finally, we have the feedback form. Now, this is the most important document probably to me because it gives me the opportunity to find out what I'm doing right, what I'm doing wrong. It finds out what you guys are most interested in, how I can improve this presentation. That being said, if you wanted to meet with me, this will also give you the opportunity to indicate that on the form. If you don't want me to contact you, feel free to say, do not call me. I'm not going to be offended. I have a pretty thick skin, so if you don't want me to contact you, go ahead and just write it down. I will not do so, and I will respect your wishes. Any questions about the packet? Beautiful. So let's jump right in. Today we're going to talk about RMDs. We're going to talk about everything you could possibly want to know. We're going to talk about what are they, why do they exist, how do we calculate them, how do they affect your taxes, how do they affect Social Security, how should you balance your portfolio and properly asset allocate so you're not going to be cannibalizing. And finally, what are you going to do with that money once you take it out, and what's going to happen when you give it to your beneficiaries? So let's jump right in. What are RMDs really? Why do they exist? Well, we know what they are. They're required minimum distributions, essentially money you have to take by law out of your retirement account. Now, you'll notice very quickly as we go through this presentation that the way we think of things is actually very different with the way the government thinks of things. If you have $20,000 that you want to put into a retirement account, you think of that as, hey, I'm saving $20,000 towards my retirement. How does the government look at that? On a very basic level, if you have $20,000 in the 25% tax bracket, do you know what kind of taxation you're looking at? Anyone doing the math in their minds? It's about $5,000, right? So with that $5,000, you think, okay, I'm just going to sock that away into the retirement account. Now the government, again, see things differently. They think, no. You are not going to just sock that away. That's actually a loan. You see, the government's giving you a loan. Did you guys know that? A lot of people say, wait a minute, a loan? What are you talking about? The government, like I said, see things very differently. While you see that as putting money away for your retirement, they see it as a loan. What happens when you take out a loan? You have to pay it back. And that's exactly what happens when you have to take your RMDs after age 70.5. So that's all that happens. It's a loan that the government's giving you. They're giving you the opportunity to watch that money grow tax-free, tax-deferred, until the age of 70.5 when you have to start collecting. Any questions up till now? Pretty clear so far? Great. So when do you have to take your RMDs? Well, as you can probably see from the screen, the short answer is 70.5. Let's talk about that more in detail. So it's going to be based on your age. It's going to be based on your balance, right? So at age 70.5, the year you turn 70.5, you have until December 31st of that year to take your RMD, period. That's ongoing. Now, your first year, they give you a little more time. They give you to April 1st of the following year. So at this point, some people may kind of mentally check out and say, okay, I know what I need to know, and I'll zone out for the rest of the seminar. Not so fast. When you decide to claim, when you decide to take your RMDs, really is going to depend on how much you're making. Let me give you an example. So if hypothetically you're a high earner, right? Do you really want to take double taxation in that second year? Conversely, if you're making more money in one year versus the other, maybe it does make sense to take double the hit in that particular year versus if you're making more money this year. So whether you take now or whether you take later, again, a very good question, something we'd love to talk to you about. We can actually plan and strategize how this can best work for you. Now, there is an exception to this rule, right? And that exception is, I'll give you an example. I should make this a case study slide, but I'll just make it short and sweet. So we have someone who basically is still working, a teacher who actually is still working, and she's collecting her 403B. So knowing that she's still working, she does not have to take out her 403B for RMD for that particular 403B. That being said, she has another 403B from another employer. So does she have to take from this other 403B? Yes, the answer is yes. It only applies to this particular retirement account, not the ones that she's terminated her employment with. So again, that's the only exception to the rule. And again, this keeps going back, and you'll see the ongoing theme through the workshop. The devil is in the details. Learn the details. So how much do you have to take out, right? That's the big question. So we'll get rid of that big question mark above our heads and just dive right in. It's based on two things. It's based on your age and the balance on your account as of December 31st. And as you can see on screen, there is a formula. There's a method to the madness, right? So that formula is basically the balance on your account as of December 31st of the preceding year. And then you divide that by your IRS assumed life expectancy. Now you're going to get that LE, your life expectancy, from something called the Publication 590. The Publication 590 is a simple chart, and it looks a little like this. And you can easily just Google it if you don't believe me this is accurate. So this is going to give you a range. This is what the IRS deems as your expected life and how you're going to start claiming. So that you're going to look at the age and get what's called the distribution period. That distribution period number is basically the factor or the divisor. And again, all you're doing is taking your balance as of December 31st of the prior year, dividing it by, in this case, 27.4, and then you'll get the information you need to make how much you withdraw your RMDs. So keep in mind, this chart in particular is if your spouse is within a 10-year period. If it's more than that, or way less than that, then there's a different chart. I'm going to skip that just for time purposes, but if that's an issue, again, come see me. So yes, 590 publication is what you need to know. So let's take that formula. Let's break it down. So let's say you have $100,000 in your IRA account. You're going to divide that by our number, as we see up here, 27.4. That's your life expectancy. And then that's going to give you your RMD amount. And that's not how much you're taxed. That's how much you have to take out to be taxed. You're taxed on that amount. Does that make sense? So depending on your tax bracket, again, this is going to be based on your individual situation, but depending on what tax tier you're in, that's going to dictate how much you're taxed on that particular amount. In this case, it's $33,649 for your RMD. So if you're taxed, I think like, I don't know, 25%, yeah, 25%, that's about $900 without whipping out a calculator. Is that clear to everybody? Yes.
Please here, 100,000, all right, divided by
Yes. So this is our example. Yeah, this is our example. So if you, as of December 31st of the year prior, you have $100,000 in your IRA.
Right.
We're clear with that.
Right.
So you would look on this table, our Publication 590, and let's say you're 70, right? You just turned 70 and a half, so now you have to take your RMD. That's going to give you the number you need to know, 27.4. Okay. So we go back to our formula, and then we divide 27.4 by 100. That's going to give you $3,600, roughly $3,600. And that's going to be the amount you have to take out. Now, depending again on your taxation tier, you're going to have to multiply that by 0.25, whatever it is. I don't know what your tier is and where you are with your income, but basically that's how much you're taxed on. And your CPA, your accountant should know this. If there are any questions, you can talk to him or me. Ironically, I've talked to a lot of CPAs in seminars just like this who didn't know a lot of these details, which has me a little concerned. So just definitely check with someone who's familiar with this information. Don't rely 100% on one particular individual, because I guarantee they'll come back to haunt you. Just like you wouldn't rely on someone to make sure you take these RMD out. Usually custodian's responsible, but don't rely on a custodian. Any questions about any of this? Please.
So the next year, say somebody's 71, then it goes according to the table that you showed us, the number, the new number, or does it stay at 27?
No, it will always change. It's a moving target. So let's go back to our Publication 590. So if you're 71, it goes slightly down, 26.5. So it's different. It's going down slowly, but it's still there. That's going to be your divisor. Yes?
Is this a chart consistent every year, or is it change every year?
They change it every so often. This one's been changed at 2012. So it's not changed often, but it does change, to answer your question. Yes.
Does the number, like 26.5 to 71, would that change if your 100,000 grew in the year?
This is not changed based on, I think your question is, does it change based on the balance of your IRA? The answer is no. Is that what you're asking?
I mean, because the 100,000 could fluctuate.
Correct, but you're always going to divide it, for example, if it was $200,000, you would still divide it by 27.4. Here's a little bit of trivia for you. Does anyone know how much money the IRS makes on RMDs? Give it a wild guess. Trillions? Not quite that much, but you're getting warm.
Several billion.
Last year they made over time, I guess you could say they made trillions. Last year alone, $2 billion with a B. So that goes to show you the IRS takes this very seriously.
So you're talking about a penalty, right? This is how
That's
much
correct.
penalty.
Right, and when again, this is your quiz, what's the penalty?
50%.
Very good. So if you make $1 over, guess how much your penalty is? It's 50 cents, right? $1 over would be 50 cents. $1,000 over, if you didn't take it, basically $500. Now keep in mind, to have this penalty applied, you have to be caught. We've had people come into our office by sheer accident, didn't know they were supposed to take their RMD and they weren't fined. Now again, you have to be audited to be discovered, but I would not rely on that. You definitely want to do the right thing and take your RMDs when you're supposed to. Did you have a question, sir?
No,
Okay. Yeah?
Okay, if I don't expect to sleep 27 years after I retire, can I take more than the minimum?
So apparently someone got their crystal ball working today. I'm very impressed. How do you know? The big question is, when do you know you're going to pass?
No.
You don't. And this is, again, this is what's an average. This is based on morbidity tables that the IRS works with insurance companies.
Can I take more than RMD?
Yes. Great question. So, and we're going to get this a little later. You're getting a little bit about the cart before the horse. But that being said, yeah. Can you take more on your RMD? Yes. There's no penalty for taking more. You can take it daily. You can take it monthly. You can take it weekly. You can take it yearly. That being said, there's no limit. You can take it all at once. There is no penalty for taking more. There's a penalty for taking less. Any questions about the yes?
So, two questions. First thing in this question was, if you're 71, but they determine it from the 100,000 in your IRA.
Well, it's not 100,000. It's determined on the amount in your IRA at that point in time.
So,
Yes.
but it's always the first amount that, in other words, if you increase your IRA, whatever, then they take it from that, right?
It's taken from the day December 31st, whatever your balance is that day, at the end of the day. And again, I don't know what December 31st, maybe it's there is a day that, I don't know if the stock market's open that day, or whether it's going to change or falter, but yeah, that's the day they look at.
So that's the figure that they always go on.
Correct.
And also back there, I was reading the last item on the previous slide. Yeah, it says the bottom one, whose spouses are no more than 10 years younger.
Yes.
So say your spouse is 11 years younger.
Yes. So again, that's a different table than this. The numbers are just a little different. And you would just, again, you can Google it or come talk to me, and I'll give you that table. Yes.
So when you said December 31st, so let's say when I'm doing the tax in April, I'm doing for the previous year,
Yes.
and I already took out the whatever minimum distribution,
Yes.
and that figure was based on December of previous year? Or
Yes.
year before previous year?
So to make it simple, right now we're in 2017. Let's pretend, what is your name?
Christine.
Christine, let's pretend that you just turned 70 and a half tomorrow, right? So as of December 31st, you would have to take out your RMD as it was.
This year.
Correct. This year of 2017. So you have to look back. If you're taking your RMDs, it would be based on December 31st, right? But again, because it's your first year, you can let it go to April 1st.
Okay. Only the first
Sorry,
year.
April 1st of 2018. Let me clarify. 2018.
Only the first year.
Only the first year,
April
correct.
1st.
Yes. Does that make sense to everybody? Okay, great. Clear as mud? Okay. Okay, great. So it has been very clear. The IRS has put a firewall between the 401ks and the difference between other retirement plans like IRAs and 403bs. What does that mean? So how you take that distribution is going to be very different. Again, the devil's in the details. It's going to be very different between 401ks and other plans like IRAs and 403Bs. If you are a 403B owner, you are probably a teacher or work at a church or a hospital, right? You would have the option to take it one of several ways. If you have several, let's say hypothetically you have several 403Bs, right? You've terminated your employment with other past employers. So you have the option to take from all of them, exactly 3.6% from each of them, or you can just add them all up and take from the balance. You have that option with a 403B and a traditional IRA. You do not have that option with a 401k. Very different situation. With a 401k, you have to take individually from each 401k 3.6%. Is that clear? Okay. I'm looking at confused faces if there are questions.
What did you just say,
Okay.
3.6%?
3.6% it's around 3.6% will be your first RMD, according to the table. Remember the publication 590 that we just looked at? Usually it's either 3.6 or 3.7% as your first RMD requirement. So again, you're going to have your IRA, it's usually 3.6% around there of your IRA, or 403B or 401k. Any questions about that? Okay, so let's take a case study, your second one. So let's meet Dorothy, 71 years old, really excited to take out that RMD. She knew exactly where the money would go. However, she wasn't quite sure, because she wasn't working with a professional, how to take that money. So what she thought she'd do is, just to play it safe, she'd take double the amount of money over here, and she wouldn't have to worry about the other 401k. Well, guess what happened? The IRS, like I said before, doesn't see it the same as we see things. They saw her taking more than her allotted RMD over here with the first 401k, but the second 401k, she didn't take the distribution. Guess what happens with that distribution she didn't take? 50% penalty. So again, even though she thought she was making the right move, she didn't know what she was doing, and that's why it's important you consult with a professional. There was no harm, no foul when she take double the amount with her first 403B, but the second 403B, she didn't take nothing in the eyes of, 401k. So the first one, she took double. I mean, the only penalty there, if there is a penalty, if you want to call it a penalty, she was just taxed more on that money. Obviously, if you're taking more out, you're going to be taxed more on that sum. But the second one, according to the IRS, she didn't take enough, she didn't take any money out. And of course, she got a hit for that RMD. So be very careful the way you take your RMDs. And that's why I hope that you're here today and you're taking lots of copious notes. So how does that work? Any questions, by the way, up to now?
Yeah, I'm a little bit confused when you
Sure.
said 401k. Once you retire, it become IRA, isn't it?
No. So let's talk a little bit about IRAs and retirement accounts in general. So with a 401k, that's employee sponsored. So when you have an employee you work with for it's about 90 days when you get a probationary period, some kind of promotionary period, when you have to start working, and then your IRA, retirement account, doesn't usually kick in for about 90 days. If you have a traditional IRA, you can start that on your own, or you can have it rolled over from a 401k. So this is a good question. Do you know why it's advantageous to roll over your 401k to an IRA? Great lead-in, by the way.
More flexible.
Why do we do it? I'm sorry?
More flexible.
Absolutely. There are actually an onslaught of reasons, like 10 reasons I could give you. I'll give you the top 3. So number 1, simplicity, right? You want to avoid mistakes like that, like poor Dorothy. Let's avoid mistakes. Number 2, fees. There are a lot of fees going on behind the scenes that you aren't aware of with a 401k. As much as even fees that maybe kick back to your employer for letting them give you the plan, right? So we can, in some cases, reduce those fees. We can make things simple. You'll have a point of contact. And finally, you also get more choices. So with most 401ks, you're limited to a couple stocks, maybe a couple mutual funds. Pick 1 out of 3, 1 out of 5. Well, why not do something more exciting, something that's going to give you more leverage, something that's going to give you better return, something that's going to give you more safety, right? We have no control once we pick that in a 401k. It either goes up and down and that's it. In certain years, in 2002 and 2008, guess which way it went? It went down as much as 50, 60%. Spoilers, by the way, that's for a future slide. But that being said, there are ways to protect yourself and your investments. And that's another reason to roll over the 401k. There's only one reason really to leave it alone and leave it in a 401k. Anyone know what that is? Bankruptcy. If you're going to bankruptcy, leave your 401k alone. The creditors can't touch it. Did that help answer your question? Okay.
So you're going to talk about IRA, how to do the RMD, right? Or is it?
It works the same. Again, IRA and 403B are one category, 401k is the other. With the IRA and the 403B, you can either add them up and take them, or you can take them individually.
Okay.
With the 401k, you can only take them individually. Just be aware of that. It's a major detail. Small but major, right? So again, let's talk about taxation. And before we jump into how RMDs and taxation work together, let's just give a very basic layout of how taxes work in America, right? So there are two different types. There's capital gains and there's ordinary income. Capital gains is when you sell a house or a big item, big ticket item. Ordinary income is sweat from the brow, right? That's when you're working hard or, usually from your work or alimony payments. How do you think taxation works with RMD? I'll give you a hint, it's on the slide. It's not capital gains, it's ordinary income. Which do you think is more favorable? Capital gains. And then that's why we're looking at ordinary income for the IRS. So what does that mean? Why is that? How is that even possible? So 100% of it is taxable as ordinary income, right? And there are exceptions. We're not going to get into exceptions because it's very few and far between. So let's talk about our progressive tax system. We have a progressive tax system. What does that mean? So essentially, rather than making, let's say, $100,000 and being taxed all $100,000 at the 25% level, you're taxed in different tiers. The more you make, the more you're taxed on a different level, but you're taxed on a tier level. So for example, if you make $100,000, the first $18,000, for example, around $18,000 is taxed at 10%. The next $18,000 to $75,000 roughly is taxed at 15%. And then the next $74,000 to $150,000 can be taxed at a different level and so on. So when someone comes to my office and says, oh, I'm taxed in the 17% tax bracket, I know that something's not quite right because that doesn't make sense. There's no 17% taxation tier. So I know something's amiss. They're probably getting taxed in a certain level in between, and they're not a little confused. Does anyone know what the maximum is? It's 39.6%. That's the most you can be taxed on the federal level. This is not on the slide. Does anyone know what, on a state level, what is the maximum you can be taxed? 13%. Now this is where it gets a little crazy. We're going to jump right in. So you're taxed significantly. We see here with this tier system, and the reason we're talking about it within our RMD seminar, is because we see people being bumped up to a higher level tier that they aren't aware of. Think about it this way. If, for example, you work in a consistent job, you know what your salary is, you know what you're going to be paid on taxes just because of prior experience and the last year and the year before that. What happens all of a sudden when you have to start taking more money out of your IRA and you're taxed at a different level? In some cases, again, we see that bumped up, and that's going to mean an adjustment for people, and they may be taxed differently than they were prior to that. Does that make sense? So that's something that's going to affect you, whether you realize it or not in some cases, if you're still working, for example. That being said, there's also Social Security. Now, this is a tax I know no one likes. I don't like it either. I don't even think it really shouldn't be taxed. For those of you who aren't aware, Social Security was a safety net financially that the government started during the age of FDR, after the Great Depression, right? And at that time, he made an oath to Americans. He said, ladies and gentlemen, we will not tax Social Security. Fast forward to 1980s. Guess what happened with Ronald Reagan's era? What did he have to do to preserve its integrity? He taxed it. He taxed it at 50%. That's pretty high. And guess what Clinton did during the years of Clintonomics? He taxed it even more at 85%, depending, of course, on how much you're making. So again, Social Security, never meant to be taxed, now is, and it gets a little hairy. It's a little crazy, and I'll show you why. So when we look at Social Security, you have something called provisional income threshold. What is that? So they take all the sources of your income, including your municipality interest, meaning, for example, if, for example, you invest in a bond, a muni bond, a municipal bond, right? And let's say it's a California bond, and you're living in California, you can get certain tax advantages and not have to pay tax on that. Now, even though you may not be being taxed on that, it's taken into the formula to basically compute whether you have to pay Social Security. What gets even more bizarre is they take the amount of money you would get, half of what you would expect from your Social Security, in the formula to dictate whether you have to pay Social Security tax. I mean, does that even make sense? That's in the formula to dictate whether you have to pay Social Security. It doesn't make sense, but that's how they do it. So let's take an example. So if you're making $25,000 if you're single, or $32,000 if you're married, then you're looking at roughly about half of that's going to be taxed. Everyone with me so far? Right? So again, we're just talking about Social Security. This isn't taking into consideration other income sources. This is just on your Social Security. So if you're making $25,000 or $32,000 if you're married, you expect over that threshold 50% taxation on your Social. Conversely, if you're making over $44,000 regardless of whether you're single or married, then you can expect to be taxed at an 85% tax. Now again, that's not the tax you have to pay, that's the amount you're going to be taxed on. Big difference there. Is everyone clear on that? Okay. So when you add this stuff up, this is what gets crazy. So you're paying, let's say you're in the 25% income bracket. You're paying 25%. Then you have your state that you have to pay coming along, right? That's upwards of anywhere from, I don't know, maybe 25% tax bracket. You're paying, I don't know, 7 to 13% maybe? Not 13%, maybe less than that. Then you have to pay your Social Security tax. You're taking your dollar, and you have 85 cents of that dollar you're putting in the front of your tax return. By the time you're adding this all up, you're looking very close to potentially a 50% taxation. 50% taxation. I don't know about you guys, I never ever voted on a 50% tax bracket, did you? So you have to be extremely careful. The government will get its money. But there are ways, we can figure out ways to get around this where, of course, a very legal manner that you might not have to be paying tax on Social Security. There are ways we can work with the system where you might not have to be experiencing that kind of taxation level. So come talk to me, we'll be able to help you. I mean, worst case scenario, for the price of admission, if you make $1,000 on an hour conversation with me, has anyone here made $1,000 in an hour? It's probably time well spent. So you might want to consider that as one of your topics if you do want to meet with me. Any questions on taxation and Social Security taxation? Yes, Christina.
When you say like over 25K and 32K, that's all the income you made in that year, including your Social Security.
So no, if we look at all income, yes, all income sources, do you see the formula? All income sources, plus the tax-free muni interest that you're not normally taxed on, but in this case, they're pretending you are, then you get half of your Social Security benefits you're expected. Once you call up the Social Security office, they tell you that information. You can also go online and look that up as well. But that's how they calculate the formula. Pretty hairy. Any other questions? Okay. So now this is an area I'm most passionate about, asset allocation. What does that even mean? So we want to figure out how you're going to work with your portfolio to generate income to be able to live on rather than eating into your portfolio and watch it go down and down and down until you have nothing left. And I'll give you an example. This is another fun case study, well, not so fun case study. So this is Sally, and Sally came to me. She had an advisor before, and at age 60, she decided to talk to her advisor and say, look, all my family members died in their 70s. I don't expect to live a long time. Just get me through my 80s, we'll be fine, right? So the financial advisor did exactly what he was told. He worked with her assets, managed everything, and lo and behold, 20 years goes by, and she was doing fine until, whoa, what happened? She's at age 85, and suddenly she's living a lot longer than she anticipated. Then what? I never, ever want to have a conversation with any of my clients, nor do I, about having them run out of income. It is the biggest faux pas a financial advisor or even a stockbroker, well, stockbrokers aren't looking after your best interest, but probably the biggest faux pas a financial advisor can do is to have you outlive your money, right? So in that case, we're having to work things out, move things around. She had to go back to work. There are solutions. You may not like them, but she's having to live within a very tight budget. She had to go back to work. And now, unfortunately, at age 85, in her golden years, when she's supposed to enjoy her retirement, enjoy her hobbies, visit the grandkids, she still has to have a job. So again, if we anticipate this and make the appropriate decisions we can avoid situations like Sally. So before we dive in, any questions to this point? Okay, so in piggybacking off Sally's situation, how could we have changed that? The first thing she could have done was realize that the market goes not just up, but it also goes down. And when it goes down, we have to make the appropriate allotments and understand we have to invest differently than we did in our 20s, our 30s, our 40s, maybe even our 50s, right? So I have conversations, and what I love most about my job is I talk to people from all walks of life, all ages, races, creeds, sexes, you name it. And the way I talk to people in their 20s and 30s, maybe even 40s, very different conversations they have with people in retirement, and we do retirement planning in their 50s and 60s and 70s. So let's talk about one of the biggest things we talk about, what we're going to talk about now, is the stock market. So on a very basic level, how does the stock market work? Well, it really goes either up or down, right, or flat. So if it's going up, it's a bull market. If it's going down, you're clawing your way down, it's a bear market. If it goes flat, we don't like that either. That means you're not making money either. And on some level, you're losing money because of inflation and so on. So let's talk about the last 17 years and what a heck of a roller coaster ride we've really had. So we start in 2000. The Dow was around 12, right? And if those of you don't know, the Dow Jones Industrial Average is just it's a measurement of how we track the stock market, one of many ways. It's a compilation of, price weighted, of 30 different major large cap businesses that we watch go up and down, right? So in the year 2000, we saw technology shoot everything sky up with all the dot-commers, right? Well, we saw that drop significantly. Anyone want to make a wild guess on what it dropped down to?
8,000.
Oh, just percentage-wise, what do you think it dropped? Take a wild guess.
50.
You're absolutely correct, sir, 50%. Have you sat in one of my seminars before? Just kidding. So we saw the tech crash, and that brought it down to just under 7,000, right? And what happened then? The Feds got really nervous, so what did they do? What was their solution? Does anyone know? They decided to artificially stimulate the economy. What did they do to do that? They brought down, that's always a solution. That's one of the tools. That's definitely one of the tools. But the other one was to bring down interest rates. And what happened when they brought down interest rates? People started throwing a lot of money around. It actually worked. And what did they usually put the money to? Besides the market, what else did they put the money into? Absolutely correct. Real estate. We saw, once upon a time, and you guys probably remember this, you were laughing your way to the bank when you saw 7, 12% as your annual interest or on your mortgage, right? I mean, how excited were you when you got down from 12 to 7? You were probably ecstatic. Now, what were they before? In, let's say, the year 2006, 2007? Does anyone remember? 3.5%. And right now, they're probably hovering on between 4 and 4.5. I should probably know that. My wife's actually a mortgage banker, so I should probably know that. But that being said, it's hovering around 4, 4.5, right? And that's their tool. That was one of their ways to jumpstart the economy. And the thing is, it worked. It worked too well, and it basically stimulated the economy to the point where people got really greedy. And we saw, after quite a rise in the Dow to 14.2, what happened again? It dropped. Does anyone know what it dropped down to? What percentage did it drop? Come on, guys. You were there with me. We all saw it together. Take a wild guess. I'll give you a hint. It's more than 2002. It's more than the tech crash. 60%. It dropped 60%. So imagine, and maybe you guys can remember this, going to your mailbox, you open up your 401ks or your IRAs, your 403bs, and what once was maybe at $100,000 suddenly was down to what? $40,000? Would that be enough to generate a heart attack with some people? I know I wasn't happy. What about you guys? But what does your broker say? So the first thing is you went to the house, you were panicking, your jaw dropped, you complained to your wife or your husband, and then what did you do? You probably picked up the phone or your keyboard, and you cranked out an angry email or made an angry phone call to your broker, who of course has zero control over the market, and you said, "What's going on? What happened?" And he probably told you that we had the market bottoming out. Well, what did he tell you at that point? What is the 99% of the time, what is going to be response in someone in the financial field when someone complains about performance? Buy and, you're close, sir. Buy and hold, you're right. 3 stars for you, sir. So your broker or your financial advisor is going to say, buy and hold. Stay the course, it's going to be fine. Stop looking at the share price, it'll go up with time. As a matter of fact,